Equity volatility has been a reality for investors for really since the beginning of time. And the last year has been no exception to that. We've had to deal with significant inflation. We've seen central banks take interest rates to record levels. So the Fed has gone from 0% rates to 5% rates in the last year. We've seen very significant geopolitical challenges, a very unfortunate war in Ukraine. We've seen equity markets in Canada and the US down as of March 31st, 2023. Throughout this, though, we're reminded that volatility creates opportunity. Warren Buffett has a great saying, be greedy when others are fearful and fearful when others are greedy. We often look through periods of volatility for opportunities to add to positions in great companies. And we're starting to see inflation come under control. Not that that problem is completely dealt with, but it is becoming a lesser issue. And so markets are forward-looking and they're seeing a bit of the light at the end of the tunnel. Now, for sure, we're going to have more volatility in the marketplace. Coming this summer, we have a big, important debt negotiation for the United States. We have some uncertainty around earnings. I think the next several quarters, businesses are going to find more clarity around their earnings growth. It's not hard to envision a period of time where we have a sluggish growth. Companies still growing, but maybe not as growing as fast as we would like. But all in all, businesses continue to have a fairly positive and optimistic outlook. We're encouraged that companies continue to focus on generating strong free cash flow in their business and returning that capital to shareholders. I think a great example of that, where we have seen a significant opportunity across our portfolios, is in the energy stocks, specifically C&Q, Canadian Natural Resources, is an energy producer that has benefited from higher commodity prices. They've also implemented fairly significant discipline on how they grow and how they reinvest in their business. And as a result, this discipline is producing substantial cash flows. C&Q in 2022 returned just over $10 billion to shareholders through a combination of share buybacks and a combination of dividend increases. Most recently, they increased it 6%. And over the last 5 years, that dividend has grown quite substantially, in excess of 30% a year. When we look at an individual stock, we think about them on a total return basis. We like to combine the income stream that can be earned through dividends and long-term capital appreciation for equity investors. For Canadian investors, the dividends from Canadian companies, there's obviously a tax advantage to that income stream that we want to avail to shareholders. When we look at businesses, we want to think about the sustainability of that dividend. So how are the cash flows of that business evolving and changing over time? What are the levers that management is pulling to ensure those dividends can grow over time? How are they reinvesting in their business? And that leads to the second part of great returns for equity investors is good companies think about their future. They continuously reinvest capital to generate excess returns, to grow their business over time. And the combination of the two of them is what we think will generate above average returns over the long term for investors. I think one example of an area where we're seeing very attractive dividend yields today and dividend growth is in the pipelines and the midstream businesses. And these businesses today are yielding around 6.5–7%, so very attractive dividend yields. And those dividends have been growing. We expect them to continue to grow. Companies like Enbridge, as an example. Their cash flow relationships or their business relationships with their customers are contractually tied in. So they have certainty around the level of cash flow that they will generate through their business. Second is their customers are doing quite well today. That oil prices at record levels ensures that their customers have strong cash flows. They're able to pay their bills. They're able to invest in future growth. That helps pipeline and midstream companies grow as well. Recently, we have had some very concerning news out of the U.S. banking system where we've seen failures of banks. And the most significant is Silicon Valley Bank, which was the 16th largest bank in the United States. And the immediate reaction was this was bringing back fears and nightmares about the global financial crisis. As a result, we saw a reaction. Financial stocks around the world sell off in fears of what could be happening. And as we looked at this, trying to understand the situation, Our view was this was not similar to the global financial crisis. There's a couple of reasons for that. Coming out of the global financial crisis, the US made a number of changes to their regulatory regime. And as a result, they ended up really with a two-tier regulatory system, one for larger banks and then one for smaller banks, banks with less than $250 billion in assets. And Canadian banks, our financial regulator, has continued to be quite disciplined and apply the highest standards. And so our regulatory system looks like, if not better, than the one that is applied to large US banks. And there's two main differences for those smaller banks where we were seeing the problems occur. The first is they are not required to take mark-to-market losses on securities that are held for sale. And so Silicon Valley Bank, as an example, we're taking in deposits, investing those assets in long-term government bonds. As interest rates rose very, very quickly, they face significant losses in those portfolios. They're not required to report those losses as part of their capital positions. In contrast, Canadian banks, their capital positions already reflect mark-to-market losses on available for sale securities. The second big difference is a liquidity capital ratio. Our regulator requires Canadian banks to hold capital so that they can withstand 30 days of stressed withdrawals. In the United States, they had a liquidity problem that all of a sudden depositors wanted their money back and they didn't have enough liquidity to meet those needs. And so Canadian banks have to maintain that liquidity capital ratio at 100%. Most of the Canadian banks are in excess of that level, 130 to 140% on average. So they're holding excess capital above and beyond what they need to do for a regulatory system. We continue to overweight the banks across our mandates. We think they have very, very strong capital positions today. They're very well managed businesses. They have demonstrated ability to generate excess cash flow and return that cash flow to shareholders via dividends over time. And so we continue to think that Canadian banks remain a strong place for us to invest for unit holders.